Welcome to the Explainer. Today, we're going to talk about a really powerful strategy that big-time pension funds use, but guess what? You can use it too. It's called the corporate bond ladder. We're going to show you how to stop worrying about your bond fund losing money and instead how to lock in predictable, steady yields. Okay, let's just dive right in. Now, for a lot of you, this picture on the left probably looks painfully familiar. You buy a popular bond fund thinking it's safe, and then bam, you see it lose value because interest rates moved. The fund's price, its net asset value, drops, and suddenly your principal is at risk. But look at the right. That is the promise of a bond ladder. It's calm, it's predictable. You get your regular income, and you know with certainty that you're getting your full principal back on a specific date. It's a total shift from hoping to knowing. So here's our game plan. We're going to walk through this step by step, starting with the problem that so many people face, and we're going to end with an actual actionable solution. By the end of this, you'll get it. You'll know how to build one of these for yourself. Let's get started.
Right, so a lot of us buy bond funds for safety, for income, the boring part of our portfolio. But then we get this nasty surprise. What most people don't realize is that when interest rates out in the real world change, the value of all those bonds inside the fund, well, they go up and down. And that directly hits the fund's price and, the value of your investment.
Think of it like a giant seesaw. It's honestly the best way to picture it. When the Fed raises rates, any new bonds being issued come with a nice, juicy, higher yield. Well, what does that do to the older bonds that are already sitting in your fund? It makes them look kind of pathetic, right? They're less attractive. So to compete, their market price has to fall. And when those prices fall, your fund's value drops. And here's the kicker. Because a bond fund is basically a forever rolling collection of bonds, there's no finish line. There's no date where you're guaranteed to get your money back.
So how do we get around this? How do we get off of this crazy seesaw? Well, we borrow a strategy from the pros, and we build a bond ladder. And this whole thing hinges on one simple but incredibly powerful idea. You hold the bond to maturity. And this right here is the crucial point. With a hold-to-maturity strategy, all those day-to-day price swings, they just become noise. They're irrelevant to you. Why? Because you're not playing the market's game. You have a direct contract with the company that issued the bond, a contract that says on this specific date, you will get your original loan amount, your principal, back, period. And this is what it looks like. It's so beautifully simple. You don't just buy one bond, you buy a few. And you stagger the maturity dates, so you've got these rungs on your ladder. In 2027, your first bond matures. Wham, you get your principal back. Then in 2028, the next one does, and so on. You've created this predictable stream of cash. And the best part? When that 2027 bond matures, you can take that cash, or you can reinvest it in a new bond that matures in, say, 2032, and just keep the ladder going at whatever the current rates are. You're in complete control.
Okay, so to actually build one of these things effectively, we have to learn to speak the language of the bond market. And look, it's not as scary as it sounds, but you absolutely have to understand the different kinds of yield. It's everything.
Okay, this is the easy one. The coupon yield is just the interest rate that's literally printed on the bond certificate. If you buy a $1,000 bond with a 5% coupon, that company is on the hook to pay you $50 a year every year until it matures. That payment never ever changes. It's fixed. Okay, now listen up. Yield to maturity, or YTM, is the single most important number you need to care about. Seriously. Why? Because you almost never buy a bond for its exact face value. YTM gives you your true annualized return because it accounts for both the coupon payments and the difference between the price you actually paid for the bond and the principal you get back at the end. It's your real all-in return. And this table just makes it crystal clear. Check this out. It is the exact same 5% coupon bond in all three cases. But if you're able to snag it for $800, a discount, maybe because interest rates went up, your actual return, your YTM, is a fantastic 7.2%. But if you have to pay a premium for it, say $1,200, your real return shrinks all the way down to 3.3%. See, the coupon never changed, but what you actually earn is totally different depending on the price you pay today. And finally, we have this little wrinkle called yield to call. A lot of corporate bonds are callable. All that means is the company has the right to pay you back early. I mean, think about it from their shoes. If they issued a bunch of debt at 7% and now they can borrow new money at 4%, what are they going to do? Of course they're going to pay off that expensive debt early. YTC calculates your return assuming that worst-case scenario happens. That's why it's often called yield to worst. It's the most conservative and, frankly, the most realistic number for a callable bond.
Okay, so we get it. We know how to figure out our real return. So the next big question is, how do we find high-quality bonds? Remember, the whole point here is predictable income. And that means we have to do our homework to avoid companies that might, well, not be able to pay us back. Luckily, we don't have to do all the work ourselves. Big rating agencies like Moody's and S&P, they do all the heavy lifting. They dig into a company's finances and give it a grade. Now, for a safe, reliable income stream, most people are going to want to stick to what's called investment-grade bonds. And you can see on the chart that's anything rated BBB or BBB and higher. Once you cross that line into speculative territory, what people call junk, look at how that default risk just skyrockets. And here is a perfect real-world example of how the market thinks about that risk. On the left, you have Sanofi, a massive, stable drug company. Their bond yields a little over 1%. On the right, a bond from a struggling retailer like Bed Bath & Beyond with the same maturity date, yields over 7%. The market is screaming at you. It's demanding a much, much higher payout to take on the much, much higher risk of lending money to a company that might not be around to pay it back. Your job is to find that sweet spot of safety and yield that lets you sleep at night. Okay, we have to be brutally honest here. We have to talk about the risks. Because while holding a bond to maturity protects you from that interest rate seesaw, it does not protect you from the biggest risk of all, the company just flat out failing and defaulting on its debt. This is it. This is the single most important risk you have to wrap your head around. What happens if the absolute worst-case scenario plays out? The company you loaned thousands of dollars to declares bankruptcy. Where do you stand in the wreckage? So here's the good news, if you can call it that. As a bondholder, you are a lender, not an owner. That means you are at the front of the line. You have a legal right to get paid back from any assets the company has left before the stockholders see a single penny. But, and this is a huge but, here's the brutal truth. If the company's assets are worth less than its debts, you could get pennies on the dollar or nothing. Being first in line to an empty pot doesn't help much. And this is why sticking to high-quality investment-grade companies is so incredibly important. The other risk to know is liquidity. The credit spread is basically just the extra yield you get for taking on the risk of a corporation versus buying a super safe government bond. Now, if the market suddenly gets nervous about the company you own, maybe they have a terrible earnings report, that spread widens, and that causes the market price of your bond to drop fast. Now, if you hold to maturity, it doesn't matter. But if you suddenly need to sell that bond for cash before it matures, you might have to take a big loss. It's a risk to your flexibility. Okay, we've covered the why, the what, the terminology, and the risks. So now for the fun part. Let's put it all together into a simple, repeatable process for building your own corporate bond ladder. This right here is your 5-step blueprint. It turns all that theory into actual practice. First, you set your rungs. Decide how much to invest and over how many years. Step 2, you filter for quality. This is non-negotiable. Stick to investment grade. Step 3, you compare the real yields using YTM and YTC. Step 4, and this is crucial, you diversify. Don't put all your eggs in one company's basket. Spread it around. And finally, step 5, you buy the bonds and you execute the plan. You hold them to maturity and collect that predictable income and get your principal back. So let's end with this thought. When you move from a passive fund, where you're just a passenger along for the ride, to an active laddering strategy, where you're the architect, you're not just buying bonds. You're buying predictability. You're buying control over a piece of your financial future. And yeah, it's a little more work up front, no doubt. But in a world that feels more and more uncertain, it provides a level of contractual certainty that is really, really hard to find anywhere else.